job openings and things like that, and we do see it happening.
The Consumer Price Index, or CPI, which measures the price of everything from groceries to cars to rent, has in fact declined from its peak. But this personal consumption expenditures, this is the PCE index, which measures, as we were talking about, consumer spending, remains historically high. How else can you account for this difference when it comes to a rate hike pause?
Well, we never used the word pause, and I wouldn't use it here today. What we did was we agreed to maintain the rate at that meeting. Almost every single of the 16 of the 18 participants on the FOMC wrote down that they do believe it'll be appropriate to raise rates, and a big majority believes raise rates twice this year. And I think that's a pretty good guess of what will happen if the economy performs about as expected.
I think you're right. More rate hikes likely are needed to bring inflation back down to the 2%. And, we're concerned about a hard landing, about recession. So anyway, my time has expired. And I now recognize a gentleman from Illinois, Mr. Caston, for 5 minutes.
Thank you, Madam Chair. Thank you, Chair Powell, for being here. So in June of 2021 at the Green Swan Conference, you said, climate change poses profound challenges for the global economy and the financial system. In October of 2021, FSOC's report on climate-related financial risk for the first time identified climate change as an emerging threat to U.S. financial stability. And in December of last year, the Fed released climate supervisory principles for large banks that said, quote, financial impacts that result from the economic impacts of climate change and the transition to a lower carbon economy pose an emerging risk to the safety and soundness of financial institutions and the financial stability of the United States. You've made many comments today that I think are broadly consistent with that in your role, and I appreciate the comments you've made in that capacity. Can I safely conclude that in June of 2023, 6 months after that release, that the Fed's position is still that climate change presents a risk to the global economy and the financial system?
Yes, I mean, I hasten to add, though, that our role in this is an important but quite small one around bank regulation.
Understood, and I'm not asking for the role, I just want to clarify that. The reason I asked that question is because on May 11th, your colleague Christopher Waller at a speech in Spain said, quote, climate change does not pose a serious risk to the safety and soundness of large banks or the financial stability of the United States, and went on to say that the risks posed by climate change are not sufficiently unique or material to merit special treatment relative to others. Should we understand as we sit here that Mr. Waller was speaking in his personal capacity and not as a designee of the Fed, if indeed Fed policy hasn't changed since December 22?
Well, I don't comment on the things that my colleagues say.
So I understand, but you understand the concern that if markets and regulators are to understand that the Fed has a consistent policy, and one of the members of the Fed is saying something that appears to be directly opposed to Fed policy from 6 months earlier, that's a concern.
Again, it's governors have always had the ability, and Reserve Bank presidents as well, the ability to have their own views on things, and that's going to happen, and that's probably a good thing that we have a diversity of perspectives. I think there may be less in that difference than you suggest. I mean, what I'm saying is that banks, to the extent we have a role, it is to assure that banks understand and can manage the risks that they do face from climate change.
Okay. I don't want to create internal tension, but I think we're all aware that you, above anyone, is aware that your words are closely scrutinized, and we were concerned with the words of your colleagues there. Madam Chair, I'd like to introduce for the record a working paper from the European Central Bank, The Impact of Global Warming on Inflation. I don't know if you saw this report that just came out recently, but it says, among other things, that climate change poses risk to price stability by having an upward effect on inflation, both food prices and headline inflation. And what I wonder, without opining on their math, if in fact we are looking at a world where climate change, per the European Central Bank, is going to increase inflation, and we were to find ourselves in that world going forward, would the Fed or other central regulators say we have tools to address this, or are we going to say, well, that's non-core inflation, what are we gonna do in hindsight? Because it feels to me like we've got a major bank regulator saying climate change is running the risk of inflation, but I don't even know what tool you would use to address that.
You know, I can just say for now, this doesn't enter my thinking in any way that we would, in the near term, change our inflation goal because of climate change or the need to deal with it. There's a lot of thinking and research that over a long period of time, really the process of investing very large amounts of money in a green transition could drive inflation up, but that's not something we're thinking about today. We are not, during our FOMC meetings, we are not thinking about climate change as something that's relevant to the current inflation or to current monetary policy, and that is very much our focus today, is inflation today.
Yeah, and I guess what I'm struggling with is that if we agree that this is a systemic risk, if we agree that this leads to inflation, and we don't really know what role you have with tools, there's a concern there. Last thing I just want to end with, in April of 23, the report on SVB, one of the lessons that was noted in the Fed review said that this is an opportunity for regulators and bank managers to be more willing to adopt a precautionary perspective, and that the Fed must strengthen its supervision based on what we've learned. I'm trying to figure out with climate change, if we agree that this is a forward risk, how do we get the Fed the tools to apply a precautionary perspective?
The gentleman's time has expired. The chairman can submit an answer in writing to the record. And I now recognize myself for 5 minutes. Chairman Powell, in March, you confirmed to me that the Federal Reserve is a consensus organization built on garnering broad support before agreeing to any proposal. And given the breadth and scope of the potential changes to the capital framework that is under review right now, that consensus-driven approach seems to be all the more important. I am concerned that the Vice Chairman for Supervision is seemingly been given far too much latitude to act unilaterally, and especially in light of Section 1107A1 of the Dodd-Frank Act, which provides the Vice Chairman for Supervision authority only to develop recommendations for the board and oversee supervision and regulation. Can you speak to the process that's underway? Is the Vice Chairman acting unilaterally, or is that a wrong characterization? And if so, if it's just a recommendation, can you walk through the steps that the board will take from recommendation to a vote?
Sure. So I think what you see is very much the way the statute works, which is that the Vice Chair for Supervision has the responsibility, the obligation to develop regulatory proposals for the board that will be considered by the full board. He's, as I mentioned before in another context, he's not the comptroller of the currency. He brings proposals to the board, and the board votes by majority vote to support them or not, and that's how that works. In terms of supervision,
is he including other members of the board currently as he's?
So I think all of us have been getting briefings on what's developed, but ultimately the job is to present something to the board for consideration by the board.
And how long will that, once he presents his recommendations, how long will there be debate, deliberation, and is that transparent for the public?
There will be a meeting, it could be a virtual meeting this summer to vote on these things. In the meantime, there's a lot of conversation going back and forth now. And we're sort of in that process now, but things are still moving around.
Our concern, Mr. Chairman, is that it seems like right now the Vice Chairman is writing personalized assessments of bank failures and results of new Fed climate scenario experiments without a whole lot of collaboration with other governors. And so, given that this new scheme could raise capital requirements by as much as 20%, an already well-capitalized banking system, and that the cost of such changes could be $100 billion or more in lost GDP, I am concerned with your testimony that this would only be a virtual vote. Shouldn't this be a more transparent public board meeting and a deliberative process that includes all members of the board?
It's really just a question of calendars and when will people be. It's the summer, and but that's something we haven't decided what form the meeting would take. Would it be virtual?
Well, given that it's a pretty big decision, and that the law requires the full board to make this decision and not one board member to act unilaterally, we would hope that the Fed would hold public meetings on the new proposal. Will you and the Federal Reserve Board commit also, when the proposal is voted on, to also include your economic analysis that would justify whatever capital changes are made in a quantitative form?
I don't know that, I'm not sure we'll have exactly what you're looking for, but, you know, we'll create a public record that supports the proposal, whatever it turns out to be, and the votes will be what they are, and it'll be subject to public comment and analysis, no doubt.
Well, in order for the notice and comment period to be meaningful, I think market participants will need to understand on a quantitative basis what the justification is for additional capital requirements, if in fact that's what the proposal is, given the fact that we already have a very well capitalized system. I don't have much time left, but will you also commit to proposing appropriately tailored regulatory requirements based on the complexity and size of the financial institution?
I will commit to supporting that. I can't commit to what the final product will be or what the vote will be, but as I mentioned at the outset, I do think we benefit hugely from a very diverse banking system, and I wouldn't want to do anything to jeopardize that.
Finally, earlier this week, the Wall Street Journal published an article that stated that unlike your predecessors, you have not focused on fiscal responsibility. Would you like to correct the record regarding that?
I would, thank you very much. So it was just op-ed, but it was factually incorrect. I mean, there are countless times, and you've heard me do this, I've said the same thing that my predecessors have said, which is that the United States federal budget is on an unsustainable path, which means that the debt is growing faster than the economy, and that we're going to need to fix this, and sooner is better than later.
Time has expired. Thank you, and the gentleman from New Jersey, Mr. Gottheimer, is now recognized.
Thank you, Mr. Chairman. Thank you for being here today, Chairman Powell. I'm particularly concerned that the current regulatory environment disadvantages small and regional banks. Specifically with First Republic's receivership, I'm concerned that the largest banks were given preference in the bidding process, just enabling the larger banks to grow even bigger. My understanding is that certain regional banks were unable to bid on First Republic because of an extensive and time-consuming vetting process put in place by regulators that put them at a disadvantage in the bidding process. Mr. Chairman, are you aware of a regulator-mandated pre-approval process that banks must complete to bid on firms going into receivership? And is there a notification process for informing banks that they can go through this process? Because I'm concerned that some who wanted to bid on First Republic were unable to.
So this is entirely something within the jurisdiction of the FDIC. We play an important role here, but when it comes down to selling a closed institution, that's just something the FDIC does according to their own procedures. To my knowledge, there were a bunch of regional banks involved in bidding for First Republic.
You know, to your knowledge, if any were said they could not participate, or your understanding was that anybody
Honestly,
could participate?
I'm not aware of any, but I wouldn't be. That really is a question for, you know, that's the heart of what they do. They have the lore, they have the people who have the experience and everything.
Thank you. Small and medium banks hold a large portion, as you know, of our country's commercial real estate loans. The Federal Reserve's May financial stability report stated that the higher interest rates may be increasing the risk that commercial borrowers are not able to refinance their loans, and that a correction in property values could lead to losses by banks that hold commercial real estate debt. I'm particularly concerned that such a correction threatens the stability of lenders and thousands of jobs in my district in northern New Jersey. How's the Fed looking at this and helping small, medium, and regional banks manage their portfolios or think about the risks of commercial real estate loans, and what guidance is being provided to banks given that nearly $1.4 trillion in commercial mortgages are set to mature in the next 2 years?
So following very, very closely, and I think you put your finger on it, this is a problem more for smaller banks, and not for all smaller banks, but it's the banks that have high concentrations. There will be losses, particularly in the office and in some of the mall sectors. And you know what we can do, there's a supervisory playbook, and so the supervisors are in there, they're working with the company to help it preserve capital and do the right things to get through what may be a difficult time for some banks that have a high concentration.
Thank you so much. As was discussed today, there's concerns, obviously, that banks may be tightening their lending process and processes and tightening what's available. Are you concerned that higher rates and the recent instability in the banking system will lead to a credit crunch that can make it harder for small businesses to finance their operations and potentially lead to rolling blackout of loan defaults across industries?
So we're watching that very carefully. Bank credit conditions have been tightening for a year, and that's partly as a result of our rate increases. We're very alert to the possibility that the sort of shocks that happened in March might exacerbate that. We don't see a lot of evidence yet on that, but we wouldn't have expected to. So it's something we're going to continue to monitor carefully.
Are you concerned at all about the non-banks and what the crunch that could happen on that side?
Yes, I mean, the banks are obviously highly regulated and have capital and that kind of thing, and some of the non-bank lenders are in a very different place, and so, but we don't regulate and supervise them, and so it's something we're watching.
How do you think we as Congress should be looking at the non-banks? Are there any recommendations?
Where there is same activity, there really ought to be same regulation. You shouldn't be able to conduct the same activity. We regulate these things for a reason, and if we're not regulating them appropriately, then that should be changed. But if you can just go across the street and start a business that does the same thing without the regulation, then that's not going to be effective or fair.
With Basel III conversations up and running, and obviously driving towards some conclusions, it appears, or recommendations, is that something that you've been watching? Obviously, you have Fed representation there. What are your largest concerns in terms of requirements and how you're thinking through that right now?
So I think these are going to be very important. A number of very important proposals are coming, and I would just put out a couple principles, and that is, our banks are strong and they're well capitalized. I think that's pretty broadly agreed, and I think we're going to want to understand how even higher capital is justified. There'll need to be a case made for that. Almost as important as that, or maybe more important, is that we need to respect the diversity of institutions that we have in this country. And we benefit from having banks of all different shapes and sizes, and we don't want to push regulation or capital, for that matter, to a place where only the biggest banks have a viable banking model. We're a long way from it. I just think we need to keep that in mind.
Or be disadvantaged compared to our foreign banks. Okay, thank you so much. I yield back.
Thank you.
Thanks. Mr. Chairman, we have two more members here, but unfortunately, you're hard to stop at one. Can we go over just by 5 minutes? Is that okay? Okay. No good deed goes unpunished. So we'll go to Mr. Davidson from Ohio for 5 minutes, and Ms. Garcia from Texas for 5 minutes, and then we'll wrap. Thanks.
Thank you, Chairman. Chairman Powell, thank you. Thanks for the extra time so we get all these questions in. And just picking up where my colleague, Mr. Gottheimer, left off, talking about non-banks and banks and kind of the regulatory framework. Recently, you published online the list of master accounts that the Fed has. Are any of those master account holders non-FDIC insured entities?
Are any of them? I don't know.
Could you get that answer back to us, please?
Sure.
Okay, thanks. So when I think about some of the dynamics that are going on in the market related to banks, non-banks, securities, not securities, one agency in particular has been very activist in this place over at the SEC, and it's kind of tangentially related to the Fed, but crypto and digital assets in the U.S. has got a market cap of around $1.1 trillion right now. It's been there for a bit. Do you acknowledge that this asset class has staying power in the U.S. economy?
It appears to have some staying power. Of course, that 1.1 trillion was, what was that a year ago? A lot higher.
Yeah, it's had some volatility in large measure due to the lack of legal clarity, and so hopefully this committee will help that quite a lot here this summer with at least two bills, one on stable coins and one on market structure, and it'll be clear not just for Congress but for regulators, including Chairman Gensler, and obviously market participants, whether they're forming the ideas or investing in the ideas or participating in the activities in the space. But when I think about participating in activities, one of the core functions that has taken place for a while now is the reverse repo market. So it's hovered over just over $2 trillion for the first half of this year, and it follows kind of exponential growth that we've seen over the past few years. So what's your assessment on the implications that the reverse repo market has on our economy?
Not much. It's just a place where that holds money on the Fed's balance sheet. It's like a mutual fund. I mean, in fact, it's as the Treasury has been issuing bills to refill the Treasury General account, we've actually seen the reverse repo overnight facility declining. So
Isn't there some sort of conflict with higher reserve requirements, liquidity, and lending in the market? Or is there any tension there?
I don't believe so. It's just a place where largely money market funds have been putting their money, and as rates normalize in the economy, we're likely to see the reverse repo facility shrink dramatically, and I think without particularly important macroeconomic effects.
If you think about the implications, the Fed had to intervene in September of 2019 to provide stability and liquidity to that market. The fact that the Fed needed to use an emergency facility to intervene in the market would normally indicate some cause for alarm. Do you feel like that was an aberration? There's no more cause. Everything's been settled.
Well, that was about suddenly finding ourselves in reserve scarcity. So we'd been monitoring the level of reserves really carefully and thinking that we knew where scarcity would start to appear. And the problem is demand can be very volatile. So demand spiked and there weren't enough reserves. So you had a situation where we had to supply reserves in big quantities. That's not what's going on with the reverse repo facility was at zero for a very long time. And I think it's shrinking now. We don't know how much it will shrink.
Well, I think the growth of it kind of highlights some of the related concerns for inflation and tension between liquidity and frankly, when you look at the requirements for capital and the alternative returns in the market, there's concern. Well, all that capital can't be deployed in the same place. So when you have to pick places for it to be deployed, then it certainly has implications. So I would love to follow up with you on it. Maybe align my own views with thinking at the Fed and with some market participants. When I think about the Federal Reserve, of course, we think about monetary policy, and we want Fed autonomy on monetary policy to some extent. A lot of non-market intervention that to me continues to be a cause for concern. Continued purchases of mortgage-backed securities, for example, prevent real price discovery. Is Fed's purchasing propping up prices, or is it holding them artificially low? It's a non-market influence, and I think it has some distortions. So as chairman of Housing and Insurance, I continue to be concerned about that. But the other thing is, really, the big concern is the regulatory side.
Gentleman's time's expired.
Yield.
We'll now recognize Ms. Garcia for the ultimate question of the day.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here today. It always is a breath of fresh air to have you here to give us the latest report on from the Feds. I first want to thank you personally for working on a topic that has always been dear to my heart and dear to the heart of the Congressional Hispanic Caucus. I know several members have already touched a little bit on issues related to diversity and inclusion, and you yourself said something, and I really was struck by the words you used. And when you look at setting the interest rates, you want to reflect that all Americans in the room when you do it. And in my view, the best way to do that is to make sure that the people at the table making those interest rates decisions reflect what America looks like. So I want to thank you again for last month joining you was Adriana Kugler, who was nominated as the first Hispanic to ever serve on the Federal Reserve Board of Governors in its 109-year history. It took a while, but we're there now, and hopefully that will help ensure that when decisions are being made,